So hello, everybody. Welcome back to another webinar organized by Princeton for everyone worldwide. We're very happy to have Gary Gorton from Yale with us today. Hi, Gary.
Hello.
Gary will talk about the recent changes and the future of the US financial system. We're very excited to learn more about it. I think it will be very useful for everybody, bridging across fields, and also useful for PhD students who look for ideas, what's going on in the future in the financial system and how to model it. Before we go to Gary, I would like to give a few remarks, and then we go to Gary's polls questions, and then finally Gary will take over. So if you look at the tech trends which impact money and the financial system, of course we have, the smartphone is impacting money. Then we have DLT, distributed ledger technology, blockchains, which has a big impact on Bitcoin. We have tokens and not account-based money anymore. And then we have big data, artificial intelligence, deep learning. This all leads to different ways of interacting. And then we have a change in the I/O structure of the financial system. So traditionally, as I mentioned before, we have a bank at the center. There's lending and deposit taking were strategic complements, so they were complemented to each other. And now we have potential in the future much more a platform-based system where banking is just one input and money management, asset management is another input to it. But everything happens on a digital platform. Think of Alibaba's or WeChat and other platforms taking over, and banking is just part of that. We live in a digital world, and that actually changes everything because data generation happens on this platform, and because of this, having this data there, and that's the informational advantage. And finances, to a large extent, is about information, is you have an informational advantage. So if you think about the tech trends, there are two important elements which connect to big data and artificial intelligence or deep learning. One is the economies of scope. You have essentially way more data for one person across a spectrum. So you have, his textual analysis, his Twitter messages, Facebook messages, his social media accounts. You have the payment data. You have much more essentially across the person. The platform is collecting all of this data, not just payments, but it collects many more data. And with new technology, artificial intelligence technology, you can analyze and bring all this data together. And that's what platforms can do dramatically better in exploiting this type of data on top of the payment data, which the banking system has at the moment. But the others, the platforms can combine it with a lot of other data, and that gives them an informational edge over the traditional banks. And on top of it, you have the economies of scale. The more people you have, the more interesting the whole system is, the better the recommender system on this platform is. So if you have a bigger size, you have bigger data, you have a better recommender system, that makes it more attractive for customers to join this particular platform, and that makes you a bigger size. So there's a self-reinforcing cycle going on. And all this will lead to a scenario where we don't have really what we traditionally always struggle with, adverse selection, or the firm or the bank or the lender has an adverse selection problem. But now it will probably, the whole thing will invert. It will be the case that the platform will probably know more about the default probability or any other things than the borrower himself. And also for insurance companies, they might know more about the likelihood to fall sick than the insurer itself. So all this Rothschild-Stiglitz and all the way we model asymmetric information will be reverted. And we will have what I call inverse selection. I've written a paper on that. So the inverse selection is everything is inverted. And now the insurance company or the bank or the platform knows more about the default probability or the likelihood to fall sick or whatever it is. And that changes dramatically the picture we're living in. So we might move to a setting, where platforms really have all the informational advantage, all the information rent is going to the platforms and not to the banker anymore. The banks are just competing, and the platform will say, okay, I have so many guys who have some credit score, and according to this, do you want to lend to them? And the banks compete all the rents away. The information rents will go and end up with the platform. Of course, banks have the chance to become a platform on their own. Then what else is going on? We will have smart contracts. Money will be paid, automatically contingent on certain events. We can program this in advance. We will probably have payments from machine to machine, the Internet of Things. And we also have micropayments, very tiny, a fraction of a cent you can pay these days. That all changes the way finance and money and all this interacts. And these are interesting phenomena. Of course, then the question is what role does the private sector play relative to the public sector? And traditionally, if you think about money in banking, we have a partnership, a public-private partnership. We have the government sector in form of the central bank providing the outside money, determining the unit of account, and to some extent some settlement, cross-settlement. But most of the money we have with checking accounts is actually provided by private banks. But in the future, the question is, what will be the future arrangement where we have the government and the banks, but then now we have also the big tech companies, and what role will they play? How will they interact with the banks? And that depends very much what regulatory framework we will set up. And these are the big questions of our times. And this is really makes finance and financial intermediation and banking more generally, the whole finance institutional approach, very, very exciting, because you now bridge, the money, and Gary will probably talk about the money aspects to money, finance, and banking. All of this is combined. So in sense, there's always a danger. People say when the government were to introduce more types of money like CBDC, central bank digital currency, you can have a checking account with the Fed or with the central bank. There's the debate, is there a possibility that suddenly there banks, private banks will be much more run prone, because suddenly you can run into the a checking account with the Fed or with the central bank. That makes runs much more likely. So that's some debate which is going on with regard to central bank digital currencies, CBDCs. But I've shown with the Knippel, essentially, that's not really a concern, because the central bank essentially steps in as a middleman. As long as you run in the bank, transfer the money, automatically the central bank is then funding the private bank by accepting this payment. So what's going on, essentially the depositor says, okay, I would like to transfer my $2,000 to the Fed, and the Fed says, okay, I accept this transfer. By accepting this transfer, the Fed essentially is lending automatically to the private bank, and then the private bank is not suffering any outflows. It's very different from a bank run by withdrawing cash, because it's not guaranteed automatically that the Fed will then, pay back this cash to the private bank. But in generally, as I mentioned before, there are a lot of aspects how to regulate these platforms. There will be competition between the official money and private forms of money. Think of Libra, Diem, digital dollarization. I talked about this before, and Jean-Pierre Landau was mentioning this in his webinar presentation earlier. Of course, Libra is now replaced with Diem for stablecoin arrangement, where Diem, essentially Facebook's currencies now, they're always attached to the dollar, stablecoin to the dollar, stablecoin to the euro, and so forth. There will be different Diems provided. What are the implications for that? So the unit of account role is preserved in the public hands. And there will be competitions among the platforms as well. And how to regulate this competition among the platform? What's the interoperability across the platforms? Is there convertibility, like for the stable coins, or is it guaranteed? Is it legally guaranteed or not? Should we treat these entities which issue particular forms of money as narrow banks? Should they be forced to hold, let's say, government bonds in return in order to have a stable coin arrangement or not? Should they be 100% backed or not? All of these are interesting questions, and Gary will put this in a new perspective and provide his light on it. And I'm very curious to find out. And of course, he will zoom back to the financial crisis, the global financial crisis, and the March 2020 COVID crisis, which was, didn't turn out to be a financial crisis because the government sector was intervening very aggressively. So with this opening remarks, I would like to go to the poll questions and just get a sense what you are thinking. And I hope you enrich us with your questions in the Q&A box. But here, these are your poll answers. The first question Gary posted was, financial crisis, are they solved now? Have we solved them? Because in March 2020, we just handled it very well. Yes or no? And 15% think no, we have resolved the issue. but it's not resolved. 85% think it's not resolved. So it's most of the people think it's still an ongoing challenge. The second question was, are there fundamentally changes going on in the financial sector? Is the financial system fundamentally changing, or is it fundamental economic problems are the same? It's just a different incarnation with all these technological developments. And 87% think it's fundamentally changing. The underlying economics is fundamentally changing. 30% think it's not fundamentally changing. And the third, after yesterday's IPO on Coinbase, now curious what Gary thinks. Can stable coins be a successful privately produced money, and will we have them? Yes or no in a successful manner? So yes, I think 25%, but 75% think we cannot have stable coins as successfully privately produced money. And we're curious to learn what Gary thinks about it, and would he invest in Coinbase in the IPO and so forth. And Gary, the floor is yours, and we're looking forward to your presentation and enlighten us with your insights.
Okay, thank you, Markus. I'm glad to be here. I'm going to talk informally today about these changes and possible future changes. And the goal is to just alert us to things that are happening which could lead to the next financial crisis. So given the results of the poll, I'm basically speaking to the choir. Has the problem of financial crises been solved? I'll talk a bit about that. Are there fundamental changes? I'll talk a bit about that. Can stable coins be successful as privately produced money? I'll talk a little bit about that. And finally, I'll end with what I call the fundamental theorem of bank regulation. So I agree with you in the poll. I forget, 85% of you said, no, it hasn't been solved. I agree. And that's because financial crises, I think, are inherent in market economies. Market economies need privately produced money. Often it earns interest, and that's very short-term debt. And every market economy in history has had financial crises. Some countries have gone long periods between crises, but then in the end they have one. So this problem hasn't been solved, right? A lot of new rules were put into place. And the last one, the liquidity coverage ratio, I think is the most devastating rule. But none of these rules really address the problem of runs on short-term debt, and in particular in the repo market. And the liquidity coverage ratio is problematic because it takes two instruments that have convenience yield, repo and high quality liquid assets, and it forces them to go together. And so you're going to have a shortage of one of them. So let me put this in some context that's important. So let me explain what this figure shows. This figure shows the components of privately produced safe debt as a fraction of total privately produced safe debt. So the first and largest of these components is demand deposits. And you can see that demand deposits was a high percent of privately produced safe debt starting in the 50s. And it started to decline in the 70s down to now a much smaller fraction. The next component is money market instruments. So that's repo, commercial paper, money market mutual funds. And the next component with the vertical lines is AAA asset-backed securities. So the red bracket is the shadow banking sector, and the blue bracket is the traditional banking sector. So although deposits have declined, loans are used to build asset-backed securities, which are then backing the money-like instruments. Now, a couple of things about this. One thing is that you can see that this change started a long time ago, and it happened over decades. And I think that's important because what's going to happen to us now is similarly, I think, going to take at least a decade. And these changes are slow and they sort of lull you to sleep. So you can see it very clearly here that there were changes. This is flow of funds data. And so you might reasonably ask, well, if it's flow of funds data, how come the Fed didn't see this picture? And the answer is the one that Einstein gave, which is that what you see is a function of your theory. So unless you had a theory about safe debt and banks producing safe debt, you would never think to make this picture. What about fundamental changes? I agree with you. Overwhelmingly, you in the poll said there are fundamental changes. And the answer is yes. With loans and mortgages, banking is moving out of the regulated sector. 50% of business loans are now originated outside the banking system. 50% of home mortgages are originated outside the banking system. And you can see that in all sorts of figures. Here's one from The Economist that shows that loans are essentially flat at about 10% of GDP, and the other possible ways of funding yourself are growing. Same thing with the mortgage market. It's the non-lender share of mortgage originations is going up. And you can see the picture here. The top blue line is the bank share, and the lower light blue line is the non-bank share. So for a long time, the banks dominated, and now they don't. What about liquidity creation? Well, on the wholesale side, all those rules that I listed for you have made the cost of doing repo, for example, very high, and they've reduced the dealer's appetite for repo. So how have the dealers responded? Well, one way they've responded is through what's called sponsored repo. So in the repo market, your costs, regulatory costs, are lower if you have a matched repo. So the borrower and the lender are the same counterparty. That almost never happens. A sponsored repo is a transaction in which a dealer bank sponsors non-dealer counterparties onto the fixed income clearing corporation's repo platform. And then you're trading with the fixed income clearing corporation on both sides. So for example, I want to borrow from a hedge fund. I introduce the hedge fund to FIC, and they lend to FIC. And then I go to FIC and I borrow from FIC. So both sides are FIC. So right now, this is only for treasuries. And there is a small cost to dealers because in effect, you have to put up margin for the party that you sponsor. But it's a very creative way to try to reduce the costs and shifting the risk onto FIC. It's also the case that
FIC doesn't need any backing. It doesn't need any capital equity support.
No, FIC is a cooperative. It's a cooperative. It's part of DTCC, Depository Trust and Clearing Corporation. So FIC asks the sponsors essentially to put up the equity.
I see.
Right. We don't know how much that is or whether there have been any problems. The other thing is that Federal Home Loan Bank's short-term debt issuance is huge. So the Federal Home Loan Banks issue debt out of one office, and they have been issuing overnight debt. You see on the left figure you can see the increase since around 2015, and it's less obvious on the 1 to 6 month. But they are now the substitute for to a large extent for repo. Commercial paper also is interesting, and it's also interesting to see what happened when COVID arrived. What's happening is the maturity is shortening. So the red line is 1 to 4 days, which is overwhelmingly what most commercial paper is, over 80%, and greater than 4 days is shrinking. So this is a phenomenon that we saw during the financial crisis, was the shortening of maturities. And what's happening is as lenders get nervous, they want to be ready to pull out, and so they shorten the maturity. So if you say, how could a firm the size of Lehman go bankrupt over the weekend? The answer is the market had shortened them up to such an extent that they knew if the paper wasn't rolled that they'd be dead. Okay, retail liquidity creation. So as you know,
Gary, can I come back to the previous picture briefly?
Yeah.
How does the picture continue after April 2020? Is it still so short or just stabilized?
Yeah, it's still short. I mean, the blue line didn't hit 0, so it flattens out, but it's very short. So it's the way I think of this is nobody really understood the pandemic because we haven't experienced one. So there was this uncertainty. And we knew that if enough non-financial firms were to default, to go bankrupt, it would eventually affect the banks. So we want to be ready for that because we want to be able to pull out at a moment's notice. That's what's going on. Okay, so the money market mutual fund reforms basically meant that retail funds were kind of driven out of existence. So how has the market responded to this? Well, they're issuing variable denomination floating rate demand notes, which comes from the municipal market, actually. This is debt, but it has no maturity, and it's redeemable on demand. It's also a retail product, so there's limitations on how much a single person can buy or deposit. It depends on the issuer, but some of them are like 400,000 is the limit. They're not transferable, so you can't write checks on them, and the interest rate is set by committee in most of them. So, and that's like a bank. So it's like a bank. Interest rates on, your checking account is set by somebody in the bank. And so this looks a lot like a demand deposit, right? Except for the fact that it's not transferable. So it's like a money market mutual fund. Now, who are the issuers? Well, the financial issuers are Toyota, a financial financing arm, Mercedes-Benz financing arm, GM Financial. But there's also non-financial issuers: Caterpillar, Duke Energy, Dominion Energy, and John Deere. So the fact that the adaptation of this product to the non-municipal market has meant that there's a number of issuers, and there's now also mutual funds that buy this stuff. I've convinced some of them anyway to issue to mutual funds, because you can only, if you have a limitation, you can't do that. So this is a market that I'm not sure it's going to grow and become large, but it is an interesting market response to the money market mutual fund problem. Okay, so what about stable coins? Markus alluded to this in the beginning. Stable coins are money. They proclaim that they have a 1-to-1 ratio with cash, so they hold reserves. They're redeemable at any time. They're transferable because you can spend them. They don't pay interest, and so presumably they have a convenience yield. Now, it's basically an unregulated free banking is what it is. And so the question is,
can I just, for the previous slides, there's some questions Ashoka Modi would like to know. The trends you outlined here is for the US. Do you see similar trends in Europe as well and other parts of the world? And then there's Philip Hartman would like to know, how big is this compared to the rest of the other short-term debt market? Is this a big deal, or is it, a side
So the
show?
answer to the first one is I haven't really studied other countries. And the answer to the second one is I don't think it's a big deal yet. I mean, nobody collects data on this. So if you go to our usual data sources, Refinitiv, for example, and you try to filter on this kind of debt, you can't. So there's nobody who collects this information in a way that you can actually compute the total amount outstanding, right? You can crawl through Edgar and you can look on the internet. So I don't think it's very big yet. I think it might grow or it might transform. But at this point, I simply observe that the market has responded to the fact that the money market funds have been, more or less driven out of existence. So we'll have to wait and see. I mean, for financial crises, what you want to do is follow the short-term debt. You want to know where the short-term debt is, right? So that's why I mention this. And we don't, so I don't know whether it's going to grow or not. Stable coins. So the question with stable coins, I think, is can they be successful? They're unregulated banking. And I'm going to define success as the way we define it for all short-term debt. The price stays at 1. So it's accepted, no questions asked. It's information insensitive. And then you can use it as a medium of exchange. So have they been successful? Well, here's an example of an unsuccessful free banking. This is the Planter's Note of Tennessee, trading in Philadelphia before the Civil War, right? So what's plotted here is the discount from par. So this looks a bit like Bitcoin. It happens that these discounts are efficient in the Eugene Fama sense, but they were pretty much of a nightmare to use as money. There were disputes over what the discount really was. There was contracting problems, because if I write a contract, in terms of $100, people are going to go buy the notes that are worth $50 per 100 face. So these are notes that were privately issued by banks, right? And the National Banking Act, although it was motivated by financing a civil war to create a demand for US treasuries, it basically created a uniform currency. And that replaced what we see here, which was a private money system that worked, and it had problems, but it worked. Here's Tether. So Tether is a stable coin. And you can see that Tether, at least lately, has been able to maintain the price at 1. Okay. So by this measure, they seem to be fairly successful. Now, how is Tether backing this? Well, here's what their website says. Every Tether coin every Tether token is always 100% backed by our reserves, which include traditional currency and cash equivalents. And from time to time, here's the good part, may include other assets and receivables from loans made by Tether to third parties, and which may include affiliated entities. Okay, so in other words, they take the cash and they lend it to themselves. Okay, this is not legal in their US banking law. And in fact, there were these rumors. Tether has been at the center of speculation for years that the coin used to facilitate trades in the crypto market wasn't backed 1-to-1 with dollars as claimed. In February, the company agreed to provide quarterly reports to New York as part of a settlement over allegations that it hid the loss of funds and lied about reserves. The assurance, this was a report they commissioned, provided by Cayman Islands-based Moore Cayman, is not part of the reporting requirement of New York, and it is not an audit. So Tether works with a bank in the Bahamas, and that's where their reserves supposedly reside. And because of these kind of rumors, they have at various points provided these kind of sort of audit reports, right? But the audit reports are a little bit vague. Like, you don't know how much of the, quote, reserves, unquote, are these, say, loans to affiliates, for example. So here's USD coin, a little bit less successful, Every month, the US dollar reserves for USD coin are attested to by top 5 accounting services firm Grant Thornton. We publish those reports so that you can be confident that USDC is always 100% redeemable for dollars. So again, the first thing to notice is that stable coins are connected to the banking system, right? Now, some stable coins have talked about putting money in escrow accounts around the world. That hasn't really happened. That would be very hard to redeem. So they tend to put the money in a bank. But the bank is not responsible for guaranteeing that they have the right amount of reserves, right? That's up to them. And the only way they have been able to do this so far is by providing these audit reports, okay? And if you look on the websites, they say, there's transparency, click here, and you'll see one of these audit reports, okay? So, it's a little bit, it's interesting. So are stablecoin issuers banks? Yes, they issue deposits. And federal law basically says that a bank is somebody who issues deposits. And then it defines a deposit as a liability of a bank, something Morgan Ricks alerted me to. But in fact, stablecoins are issuing deposits, right? So they don't pay interest, so they have to have a convenience yield, right? They have to have a convenience yield. And what is the convenience yield? Well, these are the kind of things they say on their websites. We have no data to figure out the extent to which stablecoins are actually used this way, right? We don't know. And it's also not clear, why this would dominate the existing infrastructure. Trading, moving money cross-border is widely known as inefficient and kind of clumsy, but there's FX risk. So it's not immediately clear that you avoid this with a stable coin, because a stable coin is going to be backed in terms of a specific currency. So and the whole thing is kind of confused by the fact that stable coins, trade on these crypto exchanges. There's like 15 crypto exchanges. And so the stable coins kind of get mixed up with the bubble stuff. Now, the prices, though, if we just go back to these prices, I mean, this price suggests that even though you can buy and sell this on an exchange, still it's pretty good in terms of being at one, right? So the problem is that it's not clear what the value proposition is in terms of the convenience yield, right? We don't know whether there's really is a convenience yield, or whether people are holding these stable coins for some other reason. Like, now, the issuers are going to be tempted to go longer on the asset side, because the way you make money here, given that you issue liabilities that don't pay interest, is you earn a lot by going longer, which is the source of a maturity transformation. And if it's not regulated, it's going to be like Tether, right? Tether, when they say we have receivables and we make loans to third-party affiliates, you can already see that that's happening. And it wouldn't be a large step to go, even further. I mean, you could buy stock, for example. There's nothing that keeps these guys from buying stock or issuing longer debt. So free banking never really worked in the past, even when the government required backing. So in the United States, you had to back your free banknotes issuance with state bonds as specified by the state government. And you had to deposit those bonds with the state treasury, and then the state treasury would print your notes. So it was carefully regulated. And the logic of it was, as Markus was suggesting, was basically narrow banking, where it's backed by state bonds. Now, the problem was that the state bonds weren't riskless. And the other problem was that, the demand deposits could run. So there were runs on both free banknotes and demand deposits, but the main problem was the backing wasn't credibly riskless, okay? So that's the sense in which free banking didn't work. Stable coins, there's nobody regulating the backing, right? So they're basically wildcat banking. It's basically wildcat banking. Stable coins are runnable. Stable coins don't have anyone overseeing them. And I suspect that in the end, the stable coin issuers are going to want to be regulated, right? Now, I should also point out, the big sort of decentralized or libertarian aspects of blockchain and cryptocurrency is that you're supposedly disintermediating everything, and nobody tells you what to do and so on. But when you get to money, the essential feature of holding the price at 1-for-1 means that you have to have a credible mechanism for ensuring that those reserves are actually there. And there is no credible mechanism other than the government. So this is completely different than the whole trust issue that you've probably often heard about on blockchain, where you have all these consensus mechanisms and so on. That doesn't work here. It has nothing to do with stable coins. Stable coins are a digital token, but in every other respect, it's bank money, it's private bank money. So we'll see again how this develops, but it's not clear to me that certainly in its current form, it's not going to work. And it's also not clear what the source of the convenience yield is. Now, before the Civil War in the United States, the problem was the alternative was coins, and there was a scarcity of coins. So that's why these free banknotes circulated. Okay, so there's a lot of challenges here. the
Can you
transformation.
also, I mean, so Scotland had for a long period a free banking era. Can you relate? Was it similar to the US?
So the Scottish free banks were different than the US because they had unlimited liability. And the only issue there was that they circulated because it was in a small geographical area, and I knew whose pocketbook I would go after if there was a problem. Mm-hmm. Right. So it was like when bills of exchange circulated hand to hand in the north of England in the 18th century. You know, you when I spent it, I signed the back, and everybody who signed was liable. So these were systems which depended upon knowing the identity of the backers, right? So it wasn't a system of no questions asked. You ask questions, right? You ask questions. So those systems worked if they were in a small geographical area, but to get something that works where I just accept it, I don't ask questions, and I don't need to know anything else about it, that's taken us hundreds of years. And stable coins seem to me are just sort of, you know, reliving all of history here, because, you know, it in a sense, they don't want to buy a bank and link it to them, because then they know they'll be regulated. But in the end, if there is a convenience yield to this stuff, I think they're going to want to be regulated.
If you were the regulator, what would you do? Would you regulate them out of business now, or would you just make a regulate them and provide the lender of last resort feature?
It depends on what my powers were, but I would say if you're a stable coin, you have to be a bank, and the government is going to oversee whether you have, in fact, the reserves to back your coins one for one, right? And at least initially, I would make it a narrow bank, right? Okay. Now, I think that's where the stablecoin producers will end up, right? Because otherwise it's not going to have a convenience yield, and they're not going to be able to hold the price at one. And I think because of these rumors that we saw with Tether, you already can get a sense of how there could be a bank run. Now, I mean, there hasn't been a systemic bank run in stable coins, among stable coins. And there really hasn't been a bank run on a single stable coin, right, that I know of. So these are all things we have to look forward to if they continue. I mean, this whole world is in such flux that, you know, who knows, you know, what's going to happen. I mean, you would think, well, maybe this could improve the payment system, but again, it's not clear that that's true unless you can credibly guarantee the value of this, right? I mean, the problem I alluded to earlier with free banknotes was you had this settlement finality problem, right? I have a contract with Markus. He owes me $100, and he goes buy banknotes that have $100 face value, but they're worth, you know, 50 cents on the dollar. Now, you know, you know, there were all sorts of lawsuits about this, which basically had to do with settlement finality, right? So I don't think in their current form they're going to work.
So Gary, John Cochran has a question whether the anonymity of these new forms of money is the big convenience yield, that they can keep things secret. And do you see that they might break away from a stablecoin and create their own numeria later on? And that's actually the intention, to have your own unit of account and create your own money with monetary control?
So this notion has been often talked about with respect to whether the fundamental of Bitcoin is, you know, gun running and drug dealing. I don't know if that's true. Stable coins could be used for that. But I think, and we just don't know if that's happening. I mean, even if it does happen there, you'd still want the price to be one for one, I would think. So I really don't know. I mean, I don't know whether that's enough. There's enough illegal activity to actually support these stable coins. I don't know. I guess we'll find out.
Great.
Okay, so there's a lot of challenges. I think one thing to keep in mind is the figure that I showed at the beginning, is that the transformation of the financial system takes time. And the development of the shadow banking system, started, say, in the late 70s, and the crisis was in 2007. So the trends and things that I've been talking about are likely things that are going to go on for a decade or so. And there's going to be other transformations. And part of the problem for thinking about financial crises is that these kind of transformations are not on the radar screen, right? I mean, everybody was completely surprised at the size of the bilateral repo market. I mean, it's hard to believe that you could have a repo market of, I don't know, $10 trillion, and nobody knew about it, right? And even now we don't collect data on it. So it's if some of the stuff I've been talking about grows very significantly, no one's going to know about it, right? Because we don't collect data on it, and it's nobody's job to know about it except maybe us, right? So for regulators, their problems are they should be following the transformation, even though it is not in their job description. And then they have the problem that Markus brought up, which was, how do you regulate these transnational technologies, right? I mean, right now we can't pass a law that tells stablecoins to do anything. So this is kind of scary because, these kind of changes can kind of lull you to sleep while you're getting focused on, COVID, which we should be focused on. But, pretty soon, financial intermediation will be, out of the spotlight and back, as a kind of ghetto part of finance. And that's because we're not going to observe these changes. I mean, the over-the-counter market just completely dwarfs the stock market, but the stock market's information sensitive, and so it trades in one location, so we focus on it. Okay, finally, let me talk about the fundamental theorem of bank regulation, and I think this is the conclusion, and the conclusion I think follows from everything I've been saying. Bank regulators can only decide on the location of the banking system. That's all they can do. Right? You can pass all the regulations you want. You can try to constrain the banks. But the reality is, if there's no carrot, no incentive to stay a bank, the banking system can move. And that doesn't mean that Citibank's going to go out of existence. But the fact that most business loans are made outside the banking system, that most mortgages are originated outside the banking system, most large banks take in more in deposits than they have loans to make, suggests that the banking system is moving. And the banking system is moving, I think, because it's been too costly to stay a bank. So regulators often seem to have the view that they can, or lawmakers maybe have the view that they can kind of beat the banking system up with a big stick and everything will be safe. But the problem is that the banking system can move. And the picture I showed you at the beginning was a picture of the banking system moving. And that move was very significant, and it wasn't noticed until the crisis. So let me stop and ask if there's questions. I rushed a little bit because I have to teach at 1:30.
Yes. Thanks a lot, Gary. That was fantastic and fascinating. Let me ask a few questions about, one of the carrots is probably the lender of last resort feature of the central bank providing to the banks and potentially to some stablecoin providers. Do you see also some private sectors, like before we had the Fed, JP Morgan was providing this role for some banks to be the lender of last resort? Do you see something like this in the stablecoin universe as well, or is that very unlikely that somebody would step in and help out?
I think it's unlikely. I mean, the cases where we saw a large private entity step in and bail somebody out was before the Fed. In the clearinghouses, the clearinghouse in New York did bail out some members during panics, secretly, in fact. But that's because I think they understood that if they let a big bank fail, then everybody would assume all the other big banks were in trouble. So their rule was you don't let a big bank fail in a crisis. I mean, stable coins. I mean, I think remember that at least in the U.S., entry into banking was limited for many years, right? And so you got local monopoly rents. And in many countries, there's a coalition of large banks with the central bank, and it's very hard to enter. And I think you get monopoly rents. So, but that system has, had broken down before the crisis, and it could break down again. I think the part of the problem is too that we saw in the crisis that, a lot of non-banks were bailed out as well. So, and this is the problem that we've all discussed is, how do you put a ring fence around who gets to go to the lender of last resort and who doesn't? So I don't think stable coins, I don't think are gonna be bailed out. I don't think by somebody unless they want to buy them, right? If Citadel wants to buy Tether when Tether faces a run, then they might do that. But I think we face two problems as regulators. One is that if stablecoin grows large and faces bank runs, those bank runs can be transnational, and then whose discount window do you go to? Is the first thing. Even if we let them go to the discount window,
depends which currency that stable to. If they're pegged to the dollar, it probably has to be the Fed. If they're pegged to the euro, it has to be the ECB also.
Yeah, or we have swap lines.
Yes.
So it's going to be a fun 10 years.
Do you think these cryptocurrencies / assets are more assets or more currencies in a sense? Would you regulate them as currencies, or would you regulate them as assets? Is it problematic that it suddenly becomes a whole asset class, and the general people buy them in the hope that they will make a lot of gains, and at the end it will be losing a lot of value?
So I distinguish between stable coins, which I think of as money, and non-fundamentally based cryptocurrencies. I think the cryptocurrencies are assets. And when the SEC charged Ripple with illegally issuing XRPs, I think that was correct. So I think if you're an entity that a platform says our thing is backed 1-for-1, that's money, and everything else is an asset.
Do you see that the financial profession or the economics profession has some duty in terms of financial literacy to teach the public, what dangers there might be? Do you think we should put all the effort to teach essentially the regulators, or more the public, to make them alert of these dangers you outlined in this presentation?
Ooh,
and how would you do it?
I don't know. I mean, there was like 2.5 years during and shortly after the crisis where I ran around and tried to educate the public. I probably gave 70 talks a year, and I failed. It's just flat out, I failed. And the problem with educating, we told the regulators the words moral hazard, and that's the only thing they ever remembered. So now, they think everything's moral hazard. So I guess I would prefer to talk to regulators and central bankers, because the public is, we already have a larger problem with the public about science, and so it's got to be the regulators. Most of my students, by the way, go to feds.
And do you see a way to do some self-regulation here, or do it has to come with, we said you shouldn't only use a stick because you need a carrot as well. So would self-regulation be any solution for that, or that's hopeless in this case?
Well, if you look at the historical example of clearinghouses, the clearinghouses were essentially quasi-central banks, but they knew that they had to save each other, because without information, depositors couldn't distinguish one from another. And it was that feature that bound them together as one during a financial crisis. In fact, in a panic, clearinghouses would issue money, private money, clearinghouse loan certificates, which was a claim on the joint. It was a joint liability of all the members, right? So they officially legally became one entity. I don't see any kind of network externalities like that in the crypto world or with stable coins. I mean, it could happen that if we observe a run on Tether, everybody says, oh, USD coin must have the same problem.
Yes.
right? Then you would see the beginnings of some joint efforts to do something about this. But I think we're pretty far from that. It's not even clear this stuff is going to work.
But you don't think there should be some private entity forming a club to say we set something similar up as the clearing houses for the stable coins, such that they can help each other? Because if there's a run, it will probably spill over to all the stable coins and they all go down simultaneously.
You know, when I watch these guys grapple with these questions we're talking about, they know nothing about history, so they're living all the stuff they should already have known. You know, and so I would say that you need to have a big mass stablecoin run, and then they'll start to think about this issue. But if you read their, I mean, when they say white paper, it's not very detailed. Like when they talk about reserves, there's just no real detail, right? And they say things like, oh, we have to create trust. There might be a bank run. I mean, they're aware of these things, but they're sort of groping. And it's not the technology. It's not the technology is kind of straightforward. There's two things. How do we create trust so it changes hands, no questions asked? And how is this thing going to have a convenience yield?
So let me ask you something else. I mean, there are two views about financial crisis. One is that, you know, I want to avoid all the financial crises and the problems are building up, and then I have a big financial crisis down the road. And the other view is occasionally a smaller financial crisis is actually good because it alerts of all the weaknesses. Would you say in this case, it might not be bad if there's some financial crisis coming in this space in order to, you know, alert us and also the public what the dangers are?
Well, I think in the stablecoin world, you know, eventually it would be nice to have a small crisis, right? Because then at least we'll be, you know, aware of how big this world is and what they're doing and so on. But more generally, I think there's a very serious question here, which I don't think, you know, we can answer. I mean, suppose I said to you, which would you rather have? A very big crisis every 50 years and have financial innovation? Or do you want to have no crisis for 100 years and we have, you know, very little innovation? So there is a paper in the QJE by Roncier, Tornell, and Westerberg, which is a very, very interesting paper. They look at emerging markets, and I won't bore you with, they have a model and empirical work, and they show that emerging markets that have crises do better, right? And that's because they had a financial liberalization, it had a crisis, but overall they did better. I'm not sure that's true of developed economies, but, you know, we don't know. We don't even know what bank regulatory systems, you know, work and why they work.
So I know you have to teach very soon. We always end with a positive note, but if you have any suggestions, let's say for PhD students to work in this space, you know, any thought would be useful. And then we always end with a positive note. You know, you are drawing quite a dark picture here that we will be around, you know, the financial sector is moving and it becomes much less regulated and much more dangerous. Where are the hopes and the positive aspects?
Well, I think overall there's a lot of very exciting changes that have a lot of possibility for, you know, improvements. I don't know that blockchain is quite there yet. It's not very scalable. It can't do what Visa and MasterCard do, but I think it's very exciting area. That's why I said to you earlier, I'm going to teach a class on the digitalization of money. So I think these developments are pretty exciting. I never give topics to PhD students, but they're smart enough to figure out what the questions are here, I think.
Very good. Thanks a lot, Gary, and we stay in touch.
Okay.
And, it was fantastic, and talk to you soon. I call you after your teaching.
Okay. Thank you for inviting me. See ya.
See you.